Welcome to session 8. We're going to finish up with just one little bitty piece on calculating net present values here, and then as we move into session 8, we're going to start learning more about things we need to consider when we determine and decide what discount rate to use. I've got posted up here right now our reading, and basically it's our reading schedule. For this first week, I already put this up at the original lecture. But for this first week, I want you to read the benefit cost piece by Portnoy. I also have a piece, they're both 2 pages, these are all just a couple of pages long. A piece on public goods by Tyler Cowen. I found another piece on public goods and externalities by Tyler Cowen. I had recommended that you read Part 2, Chapter 5 in the Web Book of the Regional Sciences, the Garrett and Leatherman piece on benefit cost analysis. That's 10 minutes reading at best, and the link is there. I have something there, and I'm going to want you to read that as we move now into this last part. It's called Guidelines and Discount Rates for Benefit Cost Analysis of Federal Programs. For us who do this work, it's called OMB Circular A94. It has some of the basic rules and reasoning for doing benefit cost analysis at the federal level. And so it's a very good thing. I look at it all the time, especially when I need language that I need to quote in a report. I would very strongly recommend reading that. I would also recommend reading something that I've posted up there that I wrote called Evaluating Public Sector Spending in Support of the Economy, a Call for Economic Development Principles Dialogue in Iowa. You can go through that, especially the first couple of parts of that will reinforce what you've been learning in this section. The last half of this reading list are case studies, and these are the case studies that I'm going to use in the last lecture. To talk about, to give you some ideas. 2 things. First of all, the spreadsheet that I was working on when I just finished session 7, I told you I'm going to post that with formulas on the WebCT site so that you can look at it when you do your assignment. What we're just learning right now is going to be part of 3 different skill building segments. They're not that long, that are part of the final assignment. But they will sequentially feed into the skills that you'll need to do the final assignment. So that's number 1. Number 2, the final assignment, there's only one assignment for this section. I'm going to post that assignment tomorrow, I think. And so that's going to be available for you to see and to think about as you're finishing up these last lectures. Think about how you're going to do the work. Think about how you're going to answer the first part is going to be the technical part, do the calculations. The second part is going to be a memo or an essay. So I've got this information up for your benefit. This is on the website, so it's available for you. Okay, we're going to go to where I finished up last time. And where I finished up last time, I had just got done calculating net present value of benefits and costs. Here were the benefits, and I calculated those manually. And here were the costs, and I calculated those manually, given these discount rates. Okay, given these discount rates, I calculated. So this information up here was the manual calculation of the costs. This information here was the manual calculation of the benefits. Now, what I want to show you is that you don't have to go through and make a great big table like this. You can do it in a much more compact way because Excel has a function that lets you do this. And imagine that you might have calculations that are over 30 or 50 years, and you might have lots of different categories, and you might have many different kinds of scenarios and offsets. Well, what we can use something is called a net present value function, and it's NPR is the function. It's, NPV, I'm sorry, NPR, I'm thinking I'm listening to the radio. Net present value is the function, and you can see that if you get real close to your TV set, you can see that it's net present value, and then in parentheses it's the rate, the discount rate that we're using, comma, plus, and then you put in the range of the data that we're dealing with. Well, the discount rate that we're working with here is 3%, 5%, 7%, and 9%. So I'm going to put in the discount rate here, and I'm going to do benefits first. So the discount rate is 3%, and I'm going to put a comma. And then I'm going to highlight the benefit stream, and I'm going to put a return parentheses, a closing parentheses, and I'm going to hit enter. And you can see that gave me exactly the same value, the same answer I just got done calculating. You see what it did for me. And I can copy this formula then straight across. I don't have to build the big table like I did up there. Whoops, what am I doing? Oh, I have to put a dollar sign in front of my C. So let's put a dollar sign in front of my C. This is good that I make mistakes like this so that A, you know that I'm human, and B, it reinforces going back and doing something right. And you can see that all of my answers are the same as the ones that I calculated using the formulas. And we can do the same thing with costs. And in this case, I want you to pay attention to what I'm going to do, because I'm going to calculate the net present value of the discounted stream plus the original cost. So watch how I do this. I'm going to go net present value of, now at what discount rate? It's going to begin 3%, comma. Now my cost stream, I'm just going to move over one. My cost stream that's been discounted starts here at 25, B25. So I'm going to discount those values. I want to discount all of those values back to the present, plus I need to add in the original construction value. So I'm going to close that parentheses. I'm going to add a plus, and then I'm going to put a B24, which is going to be the original value. And that's going to give me exactly the same value that I had up above for my cost right up here. So you can see this is so nice and easy and very easy to do. Now, again, I have to put a dollar sign in front of all my B's. Dollar sign in front of my B's. And one more here. And then I can calculate this across. And just like I did up before, I can calculate net benefits and benefit cost calculations. Whoops. Oh, I've got these reversed. Excuse me. I've written it upside down. Delete. So net benefits are going to be benefits minus costs, and that's exactly the same as what we had before. And the benefit cost ratio is going to be the benefits divided by the costs, and that's going to be exactly the same as we had before. And voila, we got our work done. Okay, you're going to have to be able to do exactly this for the third analytic component of your final assignment. So watch this, learn this, be able to do this. Remember I said I'm going to have the spreadsheet. If you want to delete this thing and then do it and then see if it matches up, that's good practice. So there you go, you got it. Let me save this so I don't lose it. And let's go to the PowerPoint. All right. So this is what I just got done doing, the net present value calculations. So I'm going to review this. I've already talked to you about net present value, or present value. And the present value of a future value is going to be a present value of any value is going to be the future value, some value down the road. It's like that $10,000 that you had for an annuity divided by 1 plus whatever your discount rate is, raised to however many periods down the road we're talking about. So the rate equals your interest rate or your discount rate or your inflation rate, some relevant, credible rate that allows you to make this information useful to you. And N is the number of periods. If the rate is represented in months or in years, then that you have the appropriate rate. So to get the net present value of a series, we just sum all of the present value results, which is what we just got done doing for the benefit stream and for the cost stream. Now, a future value is in reverse. A future value of something is simply the present value times 1 plus the interest rate or the discount rate or whatever the rate or the inflation rate to the nth power. So what's $1,000 going to be worth if I put it in the bank and it earns 5% interest? Then I would write the future value of that. And what's it going to be worth in 5 years? The future value of that is going to be $1,000 times 1 plus 0.05, 1.05 to the 5th power. That would tell me my value in 5 years. That's a future value, and you need to know how to do that as well. We need to be able to think that way, both in terms of present values and future values when we're doing planning and policy development. And this is just what I was just talking about. And here is the little formula that I just showed you on that exercise to give us the answers. So you can do it the hard way or you can do it the easy way. I don't care which way you do it as long as you give me the right answers. Alrighty, session 8, valuing inputs and outputs. How do we come up with values for our inputs and outputs? Well, remember, the very first thing we started to talk about, ours is a market society. We rely on the market to reveal prices to us. We rely on the market to tell. So we use, in valuing benefits and in valuing costs, market prices. So that's our preference. We want to use market prices. And as long as we're satisfied with basically that prices are reflective of costs of production and that there's an overall equitable distribution of income and public goods and resources are generally distributed well, then let's use market prices. Let's use market prices. If incomes are maladjusted or maldistributed and market prices reflect these imbalances, then market prices might be a poor guide. But in general, and we don't really have issues like that we're dealing with in this country, but you could have issues like that in an emerging economy where there's a great big difference in the cost of living and the incomes that are accumulating to one segment of society that's concentrated in one area relative to other segments of society. Remember that Gini coefficient or the Robin Hood index, places that have high values that might be something that we want to look at. So, there are things. Taxes increase the cost of a product. So if you have a place with lots of taxes, then you're not really getting a good sense of the market value of something. Government subsidies might also hide the true cost of production. What is the cost of production and relative to the price that we're paying? We currently pay in the United States a government subsidy, a credit of 51 cents per gallon of ethanol that's produced. That means that subsidy, that means the market price has that subsidy built into it. And what the market price isn't telling us is what's the true cost of production. That's what the market's supposed to tell us, but the subsidy masks that. So we have a very strong preference in benefit cost analysis for market pricing to the extent that what we're trying to analyze has a value in the market. Now, short of that, we might use something called willingness to pay. And so what we try to do is figure out what people's willingness to pay might be for something. Now, imagine I want to put in some sort of new recreational configuration in an area that's in need of a new recreational configuration, but this area has never had a recreational configuration, whether it's a recreational lake or some other kind of thing. And so I don't know what these people are willing to pay for the value. I don't know. There's no revealed preference for this population's willingness to pay for this because they don't pay for this. So we try to figure out, well, what's this worth? Well, we could try it one of two ways. One is we could say, well, what would it cost you if you were going to go receive this value, this service at the nearest closest place, your transportation, your time, and then what would you pay for your entire visit, let's say to a recreational lake or something? What would be your total value of that on a daily basis or on a per visit basis? And then how would this area compare? Or what you would do, you would look at maybe a sample of places similar to what you're proposing to develop and say, what does the primary using population pay in terms of time and travel time and costs and equipment and everything else that they use to enjoy this opportunity? What's the average? Well, that's how we come up with something. If we don't have a revealed preference and a pricing structure locally, we try to find adequate examples in the region that inform us as to what people like you would be willing to pay for an opportunity to engage in this type of activity. So that's what willingness to pay is. So that's the next step. First we want market prices. That's the highest. The next thing down, then we say, okay, we can't get market price on some stuff. We can get willingness to pay. So we can try to calculate that. That involves a lot of other work. The last thing that maybe we do is something called, we use surveys to do this. It's called contingent valuation analysis. And here is a case where someone might be asked to place a value on a good that is not traded, and something that's not, that doesn't have a market. Now here's an example. Let's say that I want to widen a highway, and in widening my highway, my roadway, I'm going to eliminate congestion in a part of a community, and I'm going to decrease noise, and I'm going to decrease pollution. Now you could ask somebody to hypothetically say, what would it be worth to you if we were able to achieve these things through this project? What would you be willing to pay on a monthly or an annual basis to have less noise, lower pollution, and less congestion? And then people would write a number down based on what they think it's worth to them. You can see how inaccurate this can be. What's the value of a little bit cleaner drinking water? I didn't know my water was that dirty. I don't know. I don't know how to value a little bit cleaner drinking water because I don't know what my benefits are. But we sometimes ask people to come up with these kinds of things on contingent valuation methods. Economists like this stuff. There are lots of agencies that use contingent valuation methods, but I will also point out to you that federal government has a very stern attitude towards contingent valuation in public projects, and it's very, very skeptical of contingent valuation as a determination for the value of benefits and the value of costs, and so we don't really do it. Okay, so how do we come up with future benefits? Well, how do we know what things are going to be like in the future? But government, corporations, and companies and everybody else, we have to forecast. We have to use some kind of reasonable information to figure out what's going on. We need to know what we think the economy is going to do. We need to know what we think demographic changes are going to be like. And we have to interpolate this stuff in our calculation. And this interpolation, these projections, these assumptions are part of our benefit cost calculation. We declare our assumptions. So we may have an expectation for population change. These are things that I can look at and say, do I think this is reasonable? If somebody told me north central Iowa, and they were doing a benefit cost calculation, and north central Iowa is expected to add 15% more people over the next 25 years, I'd say that's an invalid assumption because it's going to go the other direction based on what I know. So we can look at this stuff. We can look at compositional change of the population. Remember, we did that already in terms of youth, young adults, baby boomers, and elderly people. We can look at trends and patterns in personal income, real per capita income changes. We can think in terms of overall trends in prices, things that we've got a good historical record of that seem to be very reliable, like technology. Or for specific commodities. And again, it might not be just prices, but it could also be production. We could look at changes in people's consumption patterns and preferences. We can look at history for what it's worth. History is an example. That's where we get our trends. And when push comes to shove, the best guess over the next few years is the most recent few years, unless you've had some kind of catastrophic event, like a recession. We might localize statewide or national changes using location quotients, and you can use location quotient analysis and shift share analysis to build projection models. We can use very, very fancy models, but I'm not even going to talk about that. But sometimes we do use these very fancy computable general equilibrium models that are driven by sets of what we call exogenous or out of the model changes, and we feed these into the system and see what it does to our economy and to our demographic structure. And we can use other kinds of economics. So we do whatever we can to reasonably estimate sets of future benefits. Well, benefits are one thing, but remember, I've already showed you the discount rate really, really, really matters. So how do we come up with a discount rate? What's the right discount rate? Well, what do we have to choose? Remember I said we have a preference for the market, so let's work our way through this. If the market's working okay, then we would want to lean towards private markets, private rates, because they're telling us consumers' preferences between present and future consumption. The private market rate would equal the marginal efficiency of an investment, and the interest and the interest payments that you would have to be paying for that investment would be at an efficient level. And the interest you'd be receiving as an investor would be the amount of interest that you seem or deem reasonable for the risk that you're taking. And so everybody's in balance. The market can't be improved anymore. But we don't have perfect markets. We have society-wide and within us as individuals highly differential access to capital. I assure you that I have access to capital that many of you do not have. I have a very high credit score, and I am very liquid, and I have access to capital that many young people don't have. And so so the rates that might apply to me to engage in an investment or a purchase or any kind of consumption might very well be significantly different than the rates that you're eligible for. So we don't have perfect markets because there's lots of variability. Different people pay different rates. Different regions, different areas are going to have different rates. So uncertainty is a factor, and what uncertainty is just simply unquantified risk. But accordingly, short and long-term interest rates are different. Short-term interest rates, I have more certainty, less uncertainty, therefore I'm willing to accept a lower rate over a short period of time. Over a longer period of time, more uncertainty figures in, all kinds of things that can happen. And so I command a higher rate. Well, the market doesn't work very well, so what we try to do is we try to figure out what we call a social rate of preference. And when we're moving in a social rate of preference, we're distinguishing between the private and the market preferences. Private or market preferences, we're distinguishing between that and society, social preferences. So in common parlance, I call it, when I say the discount rate, I'm not talking about the Federal Reserve, I'm not talking about private sector. What I'm talking about is the appropriate social rate of preference, or what I'm calling a discount rate. And so the social rate of preference is different than the private rate. Here's why. You and I, individuals, we're myopic. We're very narrowly focused. We tend to maximize consumption in the present and minimize the importance of savings. And if you've looked at America over the last dozen years or so, except for just recent months during this recession, our personal savings rates went down sharply, and our consumption rates went up sharply. Well, individuals' discount rates, therefore, are much too high. The rate that it takes to get me to save is very, very high because I have a preference for buying now. It takes a higher rate, a higher return, implied return on my opportunity to get me to save now. So individuals won't save. That means they also won't invest. So governments acting in their best interests are obliged to apply a lower rate to get society to invest or to buy public goods at a level appropriate to society's needs, not an individual's needs, requires a lower discount rate. And because the government is a guardian of future generations, and that people don't save enough, the government has an extra special role to play to safeguard the future by investing prudently and appropriately in public goods. So that's why we apply generally a lower rate of preference. Okay, so where do we come up with a rate of preference? We have all kinds of things. You might try to look to the market to give us an idea. The gross before tax rate of investment interest on private investment, kind of a market weight, a weighted rate of gross and net rates of return that people get. You know, if you're investing, you get a return on your investment. You got to pay taxes on that. So there's a difference between your gross and your net rate. Some socially optimal discount rate that we think stimulates for a time period what is considered an appropriate level of public investment that's adequately covering our infrastructure and our public goods and all of our needs. But that's a political decision. We've got to be careful with that. Or maybe we use something called a hybrid, some kind of hybrid approach over time. But remember, there's always this worry. People shop around for the right discount rate, so we have to have some rules. And we have other factors that we have to consider. First of all, people even if people are altruistic, even if I'm willing to invest, money is often short. And that further justifies the redistributive and counterbalancing aspects of government. Even when money is short, we want our government to try to equalize, to distribute, and to provide an adequate array of public goods. Well, this is going on currently in our current recession. We have stimulus money that is in the form of safety net money to assure health care for poor people. We have other kinds of money. Basically, it's to maintain the status quo that funds education and government services. And then we have stimulus money that invests in a whole array of public goods in an effort to bolster the economy, but they're also needed public goods. So what we get is something that I call, or other people have called, the golden rule of public investment. And I think this is important. This rule equalizes the investments between generations. And its basis is the current generation should and must invest at least as much in public goods development as to replace what it has consumed. Now that's the minimum. If our aggregate wealth is increasing over the years, our aggregate levels of well-being, then we should replace more. But at a minimum, my generation is obliged to replace what we're consuming in all public goods on an incremental and on a timely basis. All of this suggests the choice of a discount rate that's significantly below the market rate, that is highly desirable and necessary to stimulate sufficient public benefits over a long period of time, given the preferences for present consumption versus long-term consumption, and they have to be at rates that are sufficiently low to realize all future benefits. But the rates cannot be so low that we overspend on public goods. It has to be a balancing act. When the rate is too low, the present value of benefits is too high, and they're overestimated relative to the cost. So it's always going to be a balancing act. Now, there's a tendency to shop for a discount rate. And so what do we get? Well, we get something called Circular A94, and this is some rules that are part of the Office of Management and Budget. And so I'm going to start the next session with a discussion of Circular A94, and we're going to talk about this for a bit, and then we're going to move on to some of the finishing sessions here. And I look forward to seeing you in just a few minutes.